Good morning, Bowtie Nation. Joseph Hogue here. Thank you for joining us for another of these Monday market updates, 9 a.m. Eastern every Monday morning. Get you ready for the week. Stocks I'm watching, economic news that could guide the week, and a very important topic this week. Everyone out there is asking, when will stocks stop falling? Calling the exact bottom of a bear market is impossible, I know, but just understanding some of the signals that we're going to show you that are going to preview when stocks might stop falling can not only help you manage your cash that you've got set aside for stocks, but also remain confident in your portfolio and just keep investing, right? You know that the end of that bear market is near, whether it's this month or the next couple of months, and you can keep in those stocks without getting all the stress and the panic selling that everyone else is getting. If we look at bull and bear markets back to 1956, the average bear market has lasted just under 10 months, about 9 months on average. That makes the current sell-off starting at the peak there in January 2022. We hit 4,800 on the S&P 500 back in January of last year. This would be a long one at 15 months if the bear market is still in force and we haven't yet started that bull market. Now, if that low in stocks has already been reached in last October when the S&P 500 hit 3,500 and then started that late year rally, it would have been right around that 9 months average. The average bear market you also see here has seen stocks fall by an average of 28%. Now that from the 4,800 peak there in January of 2022, that would bring that index down to about 3,450, which surprisingly is also very close to that 3,500 level reached in October. So, if October was in fact the bear market low, and eventually we're going to start this new bull market, then we just went through a very common, very average bear market. Our best indicator is actually the Fed interest rate hike cycle, whether the central bank is done increasing rates and may soon cut to support the economy. So answering that is actually going to allow us to answer two questions and know whether stocks can start their bull market higher. We're going to talk about that. We're going to go to let's look at some of the stocks I'm watching this week, so stick around for that. For that, I do want to highlight an exclusive offer from Seeking Alpha. I've used the Premium Access membership for years now. Use the link I'll leave in the description below for an exclusive deal, more than 50% off. You're going to get the Premium Access a year for $99. That's less than $8 a month. You can click through there to see all the Premium Access and features. I love the dividend forecast tool to find all the stocks with the best payouts. You're going to see all the highest buy ratings for analysts. You can listen in on company earnings and conference calls recordings. You get the best articles and analysis. I know there are a lot of free analysis, free articles there on the site, but kind of hit or miss in those free articles. You're going to get the premium access articles, which are always great research. So click through there, check that out. If you like it, you're going to get over 50% off Premium Access, the lowest price you're going to find online. It's an exclusive deal. I know you're going to like it. Back to our main topic though, because this is so important, and it's not just about market timing or picking a bottom in stocks. You see, folks, understanding when stocks have stopped falling during the past interest rate hikes by the Fed not only helps you to plan your cash there and keep you confident in stocks, but it's also going to answer another question that's plaguing investors right now. Okay, why are stocks near 3-month highs if all the economic data points to a recession? Okay, we had that banking crisis. We see on Friday, the jobs report came in surprisingly weak. Only 236,000 jobs created in last month. We see ISM services and manufacturing data weaker last week. Every week there seems to be a new data point that shows us going further into a recession. And while investors love to look at 1,000 different indicators for that direction in stocks, no other source has been as accurate to be able to show where stocks are going as where the Fed is in its interest rate cycle. Whether it's easing or tightening, whether it's lowering rates or increasing rates, folks, there is a reason why one of the most followed rules on Wall Street is don't fight the Fed. Okay, the Federal Reserve controls its federal funds rate. That guides all other interest rates. It's the benchmark off of all other interest rates, corporate loans, home loans, auto loans, credit card debt. All other interest rates out there are benchmarked off of that and rise and fall along with the Fed funds rate. It is the cost of doing business, the cost of consumer loans. The Fed can boost corporate or consumer spending by lowering those rates, or it can choke it off by raising rates like it did last year with the fastest rate increase over 40 years. Okay, that's why we saw mortgage interest rates double last year. That's why we're seeing more auto loan defaults, because interest rates are so much higher right now. It's why we are seeing that banking crisis. Okay, the Fed raised interest rates, destroyed the bond portfolios of all those banks, and really caused that banking crisis. And that's why we're heading towards a recession. I want to first look at this data where stocks have gone in relation to those Fed rate hike cycles in the past, and then we're going to see where the Fed might be right now and how that's going to guide the market this year. So we got the table here, goes back to 1983. It's going to show the start of each Fed rate hike cycle when the Fed started increasing those rates on the far left. The next column is the final rate hike cycle. That's 6 cycles back to 1983. The third column here is then going to mark the number of days before the last rate hike that the stock market hit its bear market lows. Okay, so the stock market, typically, collective wisdom of the market, it does kind of know when the Fed is going to stop raising rates. It starts to build in those expectations like it has now of an eventual cut or a pause in the rate hike cycle, and then an eventual cut to support the economy. So stocks normally bottom. They normally find those bear market lows before the Fed has stopped its rate hike cycle. So we can look at data back here. We can see about how long that is. That third column, the days before the last rate hike cycle or the last rate hike that stocks have actually found their market lows. And now looking at this, I don't know if you want to take all of this at face value. While the average here, you can see the average on the bottom here, it says the stocks tend to bottom 57 days before the last rate hike. 3 of these 6 instances, though, saw stocks bottom 3 weeks or less from that final increase. So extremely close. The market wasn't previewing quite that much time from the final rate hike and the bottom in stocks. And judging from 5 of these 6 cycles, I would actually say that this 1987 to 1989 cycle, this where it says stocks bottomed 176 days before that final rate hike. I would say that's more of an anomaly and probably should be not representative of what we should normally expect. Okay, I think the collective wisdom of the Wall Street, of the investors, is pretty strong, and stocks generally do know when they're going to get that last rate hike. They can build that into expectations and start to build on that next bull market before that last rate hike even starts, but not 176 days before that. Okay, the market is not that smart, believe me. Okay, so now removing that instance though from these, so leaving those 5 other instances, drops the average down to about 33 days before the last rate hike. It's a good point for you can watch for a bottom in stocks. Now, to see how to use that for where we are right now, we can use the CME Fed Watch tool. Okay, this is a great tool by the CME Group Futures Exchange. There uses interest rates, where they are right now on the yield curve, market expectations, uses all that to build kind of a market-based probability or expectations for Fed rate hikes in its different meetings. Okay, it's going to tell us what the market is right now expecting the Fed to do in all of its meetings for this year. It even gives us a calendar here for the next FOMC meeting, the Federal Open Market Committee meeting, 24 days, 4 hours, all the way down to the second. So that's cool. So type in Google there, CME Fed Watch tool, or you can go to the CME Group and go to the Fed Watch tool here. If we scroll down, now you see a few things here. One, across the top here, it's going to give you the dates of every meeting for the next 2 years, all the way back through 2024. Don't need to go through that far. We do see the next meeting here in May 3rd, June 14th, July 26th, September, November, and then the last meeting of the year here on December 13th. You can also see here it says the current target rate is 475 to 500. Now again, remember, this is the Fed funds rate. This is the rate, the interest rate actually set by the Fed or targeted by the Fed in its operations. It targets this rate by what it's doing with its buying and selling of bonds and treasuries and things like that. And so it sets this target range. Now 475 to 500, those are basis points, and basis points are 1/100%. So you just think of this as 4.75 and 5%. Okay, 4.75 and 5% target range for the Fed funds rate right now. Now down here in this target range, and what I'm going to do here, okay, there we go. I'm going to move myself over a little bit so we can see this full chart over here. And what you can see here is these are the probabilities of what the market expects, market-based expectations of what the Fed is going to do in this meeting, this next meeting, May 3rd there. The market is now expecting a 70% probability, 70% chance that the Fed funds target is then up 500 to 525 basis points, 5% to 5.25%. That would be a 0.25% increase from the current target rate. A 30% chance, 30% probability there that they stay the same, that they stay at 500 basis points, right? So the market right now is expecting better odds, more often than not here, that the Fed is going to raise rates at least one more time here in May. And what you want to look at down here in the bottom here, just to give you an idea of the direction of sentiment, the direction of expectations on these, you can look at where those percentages are now versus 1 day, a week ago, and a month ago. And what's really interesting here is how much these expectations have changed just over the last month. Okay, just 1 month ago, you can see here there was a 56% odds. The market was expecting better odds that the Fed would be all the way up to 550 basis points on that Fed funds target. So two increases in interest rates, probably a 50 basis point last time, which they only increased 0.25%, and then another 0.25% this time. They even had a 22% chance, 22 percent market expectations that the Fed funds rate would be as high as 5.75% already right now. Of course, we had that banking crisis. We've had good inflation readings so far over the last month. So those expectations have come down. The market is saying that, hey, inflation is coming down. We don't quite know how bad the banking crisis is going to hit the economy. We think the Fed is going to pause, slow down. It's going to increase rates at least one more time here in May. But that's it. Now, if you look at through some of these other meetings, you get an idea of those market-based expectations for those different meetings and where the market expects the Fed to go. Here, if we look in June, we see another 70% here that the Fed is still at that 500 to 525 basis points, that 5.25%, 30% that they're still at 500. So what the market is saying here is the market is saying it highly expects the Fed to raise interest rates one more time in March, or in May. That would be 26 days from now. One more time increase in May there, and then to hold steady. We got 70% that they're still at 525 in June. Here in July, in July, it actually starts changing. It actually 48%. The market is saying there's about a 50-50 chance that the Fed has decreased rates at their July meeting, okay, that they decrease rates from that 525 that there were in May and June down to 5%. And presumably, this is because, we've started to see the economy really slow down. The banking crisis has really hit lending, as we've already seen it has. And the Fed is trying to support the economy. We've seen the market is saying that it believes inflation is going to come down fast enough that the Fed might be able to start lowering rates as soon as July of this year. Then you go through here, September 40% that it's at 500. 37.6 that it is at 478. Only at about a 12% chance of the market expects the Fed to still be at 525 by September. And then you click through here, November, December. By December, the market expects the federal funds rate to be down to 4.5%. Okay, so that is a market change. 4.5% top end on the Fed funds rate by December versus what would be a 5.25% by May. So that would be as many as 3 interest rate cuts by December, 0.75% interest rate cuts by December, according to market expectations. So now if we apply that to that historical data, where we saw the stocks tend to bottom about an average of 33 days before the last Fed rate hike, we are expecting the Fed to raise rates at least one more time here in May in 26 days. So that works out to be, if that is true and if that is a good indicator, then we could be looking for a bottom very soon here. Now, unless we see signs of economic strength and market expectations for Fed rates hikes change, that would make sense that stocks should be supported right now, okay, and into that Fed rate hike cycle and the potential for as many as 3 interest rate cuts or 0.75% rate cuts this year. That's, again, per expectations, that would mean a return to those easy money rates that spurred stocks higher in the first place. Now, while I do think that the Fed is going to raise rates one more time here in May, it's all going to depend on what we see from the CPI, that consumer price index, and the PPI this week. Okay, these are the last 2 interest or inflation ratings that we have before that Fed meeting. The several Fed members have come out lately and said, you know what, the Fed cannot expose itself and lose credibility by stopping rate increases too quickly before inflation has come down. So I think they're going to be adamant on raising rates at least one more time, maybe even two more times if inflation hasn't come down. But the problem here is the big problem is we still don't know how bad that recession is going to be. Okay, you know, whether rates stop going up or decrease eventually in the future. Many people are still hoping that we avoid a recession, which just isn't going to happen, folks. You have to embrace the horror that we are going to get a recession with this regional banking crisis. Regional banks affect the vast majority of loans out there, commercial loans, small business loans, consumer loans, those mostly go through those regional banks. And those regional banks have no idea where they're at right now. They don't know how much deposits they're going to have. They don't know when this crisis is going to be over. So they are tightening lending standards and not lending money out. That is going to bring the economy to a screeching halt. We're going to start seeing that in jobs numbers. We're going to start seeing that in consumer spending. With that, even if we are close to an end in those Fed rate hikes, the market might struggle to go much higher just as they see how far those corporate earnings are going to be dropping in that recession. Now, we are going to get a good idea of those recessionary effects over the next few months. Q1 earnings are starting this week, going to be coming out over the next month. And then we have Q2 earnings, so the second quarter earnings there in August. So with that kind of a timeline and the idea that even if stocks do continue to rally on a potential to the end in rate hikes, investors aren't likely to miss out on a whole lot of return here, folks, by still holding back on cash, hedging your risk a little bit. We're here looking at the S&P 500 trailing 12-month PE ratio. So the current price of stocks in the S&P 500 is right around 4,100 divided by the earnings over the last year, that price to earnings ratio. You can see the current here right around 20, just under that 10-year average there, right around 20.5. Okay. So stocks are not cheap here, and definitely not cheap enough to take a lot of risk for what could maybe be at much a 3 to 5% gain over the next 6 months, against the potential for another 10% drop if the recession is bad, another 10% drop that opens up a lot more opportunities for your cash. Now, I hear a lot of you out there saying, for me, does this really matter as a long-term investor, right? And it might not, okay? For long-term investors out there, it might be splitting hairs and not really matter that much, okay? Even with some of the weakness expected in stocks, even with the recession, buying stocks now still means you're getting about a 15% discount to that all-time high last year, okay? Remember, stocks topped out about 4,800 in January of last year. They're now down to about 4,100. That is about a 15% drop, a 15% discount right now, even after the rally since October. So if normal earnings growth happens from right now, continues somewhere around $310 for the S&P 500 companies in 5 years. What I'm thinking is right now I'm expecting 2023 earnings for S&P 500 companies right around $210, $215 for that index. If those rise by the typical, 7.5%, 8% over the next 5 years, that gets us to around $310 in earnings. If we look back on that chart, the S&P, the PE ratio over history will typically get to at least maybe a 21 times PE ratio on that index in a bull market. Okay, so if that happens, 21 times $310 per share in S&P earnings, that gets us to an index level of about 6510. Okay, so the S&P 500 rising from right now about 4,100 to 6510 in 5 years, that's about a 58% return, or about 9.7% annually. That is a great return for anyone annualized. So for long-term investors that just don't want the stress of trying to see where the market is or where it's going, just want to invest dollar cost average every month and not worry about it, that is still a very good return. Now, for those of you like myself that just hate losing money and just want to be prepared for anything, want to be able to build an idea of where stocks are going so they're not surprised, you want to make those tactical positions and eke out a few percent extra, I still do have about 15% of my portfolio in cash, of my total wealth in cash. Now, that's not just cash sitting aside. That is in the Treasury ladder that we talked about a couple of weeks ago. Frees up cash every 4 weeks to apply to stocks if they do fall. I have cash in those I bonds that is over a year old now, so I can take those out whenever I need to. I have cash in a no penalty CD that I can take money out whenever I want to with no penalties and put those back into the market when the market does come down. I've also covered a lot of my stocks with covered call options. I've sold call options against those. A lot of them until June, covered until June, and some even into January in some cases. Now, what this does is still by selecting a strike on those options, a strike for those prices for those stocks a little bit higher from where they are now, it still gives me the participation if stocks continue to go higher. I still benefit on those stocks if stocks go higher. It does reduce some of the risk, though, about 10% of that risk off of that, because I collected that cash premium. So if they don't go up to that point, I still keep the stocks, but I keep the cash as well. I'm also using the barbell strategy. It's a strategy we've talked about on the channel before. It's investing heavily in tech stocks, growth stocks, your internet stocks, communication services stocks, a lot of those. But then also the other side of your barbell, right? If you've got a barbell, you've got heavy on both sides, nothing in the bar in the middle. You've got those growth stocks, the tech stocks that are going to rise along with the market, are going to rise higher than the market. And then you've got cash and cash-like investments that are going to give you that opportunity to take advantage of prices if they do come down. So that's where we're at right now. If you've got any questions on that, go ahead and ask those in the comments. I'm going to get to the questions later on today. I do want to start with our market update, though. Some of the stocks I'm watching this week. First off here, the bank stocks. They're going to start reporting the Q1 earnings here on Friday. Banks always lead us off on earnings releases. We're going to see Friday a lot of those big banks, JP Morgan, Citigroup, Bank of America, Wells Fargo, are going to be reporting earnings. Get us started there. It's going to be a critical time for the sector, for financials, for bank stocks. We did hear that First Republic, ticker FRC, announced Friday that it would be suspending its dividend on preferred shares. Okay, this is a major move. It's a month after suspending its common share dividends to protect that cash flow. I do expect that announcement is going to weigh on bank stocks early in the week as we see kind of a reignition of fears of that banking crisis. First Republic is a San Francisco-based bank. A lot of people say that's the next shoe to drop in this banking crisis. We already had SVB, which was the other big San Francisco-based bank there, focused on startups and the tech companies. Now we have First Republic that could be going under, on that move. Been getting capital injections from a lot of the big banks, $30 billion in deposits over the last month by a lot of the big banks, including JP Morgan, trying to prop up that bank. But we're gonna have to see. And I do think that it reignites bank fears earlier in the week. Now, First Republic actually is expected to report its earnings on Thursday before everyone else, which is kind of funny. But they want to get started and could make a big announcement on its outlook. Okay, I'm expecting they're going to have to make some kind of a big announcement, right? Whether it is, its solvency, whether it is some kind of a capital injection, or just trying to relieve the market of those fears of a banking crisis, and that FRC might be the next shoe to drop. So, whether it's that, whether it's even as much as an acquisition or selling off some of its business, could be a big announcement there on Thursday by First Republic, and could lead to a big move in those shares. Earnings out from the largest banks again on Friday should be relatively good, though. Something we've been talking about on the channel for the last month is that these bigger banks, these JP Morgan, Bank of America, Citigroup, even US Bank, or the regional bank that's actually the fourth largest bank in the United States, could actually benefit from a lot of this, seeing those deposits flow from those smaller regional banks to those larger banks as depositors look for that safety in size. So we're going to see a lot of those, and I think that's going to be actually bullish on a lot of those big banks, JP Morgan, Citigroup, Bank of America, Wells Fargo, all those that report on Friday. I'm also looking at the healthcare REITs, the real estate investment trusts. Now, these have been slammed over the last year, but could get a pickup if the healthcare sector continues to improve. Okay, here we are on the National Association of REIT, their investment performance by property subsector. It's a monthly report they put out, gives you the return information, dividend yields for each property type in that REIT complex. Across the top here, you can see the all equity REITs. So all REITs dropped by 25% last year. Just had a horrible year for real estate investment trusts as those interest rates went up and increased the cost of that leverage on real estate. Healthcare REITs down here, only down 22% last year, but it dropped 5.25% just in March alone. Okay, so just healthcare REITs like MPW, like Omega Health, like Sabra, plunged in March 5.25%. They are now paying 5.5% dividend yield, very high. What I'm watching is the overall healthcare sector was the second best performing sector last week. It's still the second worst for the year, down 1.7% for the year. But just last week, very good start with a pop in healthcare stocks last week. If that continues, that could flow through to these healthcare REITs. Okay, a lot of the problem with these healthcare REITs, these healthcare property owners, is the weakness in the overall health complex, the overall healthcare complex, with that shortage of nurses, that shortage of doctors, causing wages to go up, the lack of reimbursement from the government for a lot of the processes. The reimbursement has not kept up with inflation. So a lot of those healthcare companies, a lot of the hospitals, a lot of the facilities and providers are just in insolvency issues, and that is driving fear in these healthcare REITs, these property owners. Again, though, these property owners, these healthcare REITs pay a 5.5% dividend yield. That is the fourth best among REITs here. You can go through this list, see the dividend yield on average for each property type of those REITs. Now, the thing is, I said it's the fourth best among REITs, but that's after office, regional malls, and diversified REITs. Okay, so you got office paying about 6.4%, you got regional mall REITs paying about 6.4%, and then diversified paying 6.3%. I would not be touching office or regional mall REITs right now. Okay, those long-term demand factors in office space in regional malls is negative. I would not be surprised if dividends are cut in those spaces as we see less and less demand for those two types of properties. Healthcare, on the other hand, strong demand drivers going forward, should perform well. So take a look at those healthcare stocks, those healthcare REITs. Also watching electric vehicle stocks this week. Okay, Tesla on Friday announced another price cut to its U.S. models. This move follows several other prior cuts from the largest EV maker, as well as reactionary cuts by its competitors. So it does look like we are getting into a price war on electric vehicles. Tesla started it off in January. They're cutting its prices on its models, followed by GM, Ford, Rivian. A lot of the other EV makers cut their prices. We are on a race to the bottom for EV cars. Obviously, this benefits Tesla because it has lower production costs. Right now, it is in that sweet spot where it is already bringing the cost of production down on its cars. A lot of these other companies, not so much. A lot of these other companies still have production costs, which means even at the higher cost they were selling their cars last year, they are at a loss on each car they sell. It is getting better, though. I actually started a position in shares of Rivian, ticker RIVN, last month. I'll continue to build that position on any dips. I think they're getting into that sweet spot where Tesla was maybe 3 or 4 years ago, where the cost of production for each of those cars for Rivian comes down enough that it can start being profitable on those and can start competing. Going to be an extremely important week for economic data this week. Again, the market is expecting the Federal Reserve to cut interest rates by 0.5% by the end of the year, up to 0.75% cut by the end of the year. But that all depends on what we see out of inflation. This week, we get the Consumer Price Index, that CPI inflation report on Wednesday. It's expected to show inflation did continue to slow down to just 0.3% on a month-over-month basis. That would mean that inflation has dropped almost a full percent from the last month, down to about 5.1, 5.2% market expectations right now from 6% last month. Okay, so CPI report reported last month 6% year-over-year inflation. Market expects it to be just 5.1, 5.2% this week. If it can meet those expectations or even come in a little bit under 5%, 4.9%, that would be huge. It would continue to support that Fed pivot argument that the Fed can now pause its interest rate hikes, eventually start cutting those interest rates to protect the economy, and would help stocks rally higher. If, on the other hand, that inflation does come in higher than expected, it is going to send stocks sharply lower. Check out that exclusive offer on Seeking Alpha Premium with the link below, more than 50% off. Or click on the video to the right for the 11 stocks that are just too cheap to pass up. Even if the market starts falling again, these stocks are something you want to watch. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.